Like everything else, entrepreneurship is changing too. What it is now or can be in another year or so is quite different from, say, what it was 20 years ago. To discuss the new models of entrepreneurship, we have with us Divyang Arora, a UPenn engineering graduate and a Harvard MBA. Divyang is part of a health and wellness startup in the US. He's also been an investor. Being part of the American startup ecosystem, which usually leads the trends in creating new models, Divyang is at a vantage point, observing it all firsthand. And having grown up in Chandigarh, he has a fair understanding of the workings in India as well. Divyang, thank you for joining us here today. First up, how do you think entrepreneurship has changed or evolved, say, over the last decade?
Thanks so much, Ramarco. It's good to be here. Thanks so much for the introduction. So I'd say entrepreneurship, at the core, is still the same, right? It's at the core. Entrepreneurship remains what it was, or has been forever. I think what has changed or evolved is the ecosystem surrounding, entrepreneurship. And in that sense, there's one which is sort of the trends and the technology, but then the second is the functional ecosystem. So let me talk about that. Within that, let's take a look at historically why this has come about. And I think, in my mind at least, the reason why the ecosystem has evolved or changed has primarily to do with access to capital, or rather the abundance of capital that has happened or that has flowed into the ecosystem in the last 15, 20 years. So even till the early 90s, or rather the late 90s, there were two things. A, capital in early stage investing as an asset class was not as widespread as it is today. And the second is that the gatekeepers of that capital were very, very limited. They were sort of traditional venture capital funds who control the flow of capital and where that was being deployed. As sort of startups became more successful, more widespread, as more and more outcomes became sort of more outsized, obviously this asset class became way more lucrative, and by virtue of that, you saw a lot more capital flowing into this, and within that, there's largely, let's say, three buckets where capital has increased. One is typically non-traditional venture capital investors now getting into this. So when I say non-traditional, traditionally LPs like family offices have now started sort of directly investing as well. Another example of non-traditional venture capital investors would be, let's say, public market investors, right? Like the Tiger Globals and the Mavericks of the world that were thus far limited to sort of public market investing, now having dedicated venture capital teams. So that's one. The other is sort of venture, investing at a more upstream level. So private equity funds have now, started investing in more of growth equity, sort of models, which are more like, you can call them later stage venture capital once the model's been proven out. Similarly, you have things like SoftBank's Vision Fund, right, which have really opened the floodgates to later stage investing. And then the last thing is way more downstream, which is a lot of venture capital funds being raised that are much smaller than before, but much more widespread. Some more focused on specific areas, some founded by ex-entrepreneurs as the ecosystem has matured. So a lot of proliferation of capital in every stage and in every sector. Actually, one more thing I forgot, and that was the rise of corporate venture capital funds, right? Traditionally, not a source of investing, but now a lot of corporates getting into their own venture capital funds. Example being T-Mobile having, starting a venture capital fund a couple of days ago, like $100 million venture capital fund to invest in, companies looking at 5G technology and its impact on the entire ecosystem, right? So as an example. So now all of this, what it's done is that instead of the power being concentrated in the hands of investors, in some ways the balance has slowly shifted, right? Where entrepreneurs now are in some ways more in demand, and venture investors are actually competing for the best, entrepreneurs, or for the best ideas, or for the best, companies. And what that has led is what that has led to is two things. One, venture capital firms have started differentiating themselves, or in order to sort of appeal more to founders, they've started becoming more founder friendly. And what they've started doing is offering more services. So, 15 years back, it was very simple. A venture capital firm would invest money and the startup would take it and they would, start their company. Now you have this proliferation of portfolio support, where, I think Andreessen Horowitz made it way more mainstream. It had been happening informally already, where a lot of venture capital funds have started offering operational support. They'll have product teams, they'll have sales teams, they'll have, they'll try to offer sort of a path to hiring, all those things which help a startup grow in its initial phases. But more interestingly, more than even the services thing, I think what has happened now is that the competition for entrepreneurs has made the investors go far more downstream, where even at an idea stage or pre-idea stage, you're trying to find the best people and fund them at that time, so that instead of later on having kind of an auction style approach where you give the best terms, so that's why you get the best deals. You're actually trying to find companies or founders at a much earlier stage. And I think that's, examples of that is sort of the Scouts program that a lot of VC firms are running. The Dorm Room Fund, which has partnerships with all VC firms who actually try to find people at the university or college level, and, create a champion from that level to then ultimately go to the company level. So that's how I've seen the ecosystem evolving.
Right. And Divyang, what are the latest trends in entrepreneurship that you've observed which are emerging out of the US right now?
Sure. I think, I wouldn't, so informally, these things have been around for a long time, right? I think what, when I would classify some of the things as more latest would be them becoming mainstream. They've been around for a long time. And within that, I think there's three sort of overall trends. And if we can classify them, on almost a sliding scale of independence and less support to most sort of, supportive ecosystem. So the first one is entrepreneur in residence, right? Which is probably the oldest, which is sort of the EIR program, which, at a very high level, traditionally, you had a venture capital firm that would have an EIR position where, they would hire either a second-time founder who had success with the first company, or they would hire a seasoned industry executive, or they would have, someone who joined a very fast-growing startup at an early stage. Basically, all ways to say that someone with a track record, and they would then offer them an EIR position, which is basically, sort of a 9 to 12-month landing spot where the entrepreneur can figure out the idea while staying at a venture capital firm, having kind of access to their resources, maybe a small salary, maybe office space. You're part of the ecosystem, so you kind of have a look at the trends that are happening because you're also part of the investing ecosystem because you're with the venture capital firm. And in return, the venture capital firm would offer, or rather the entrepreneur would help the venture capital in any way they could. As an example, if someone comes from an industry that they have deep expertise in, they could help them evaluate those deals. Or if someone comes from, someone has a really large network, then they could even help scout deals for the venture capital firm. So it was kind of a win-win for both, right? The beauty of this is that it's an extremely flexible program, right? It started out by VC firms offering this. Today, universities offer EIR positions. Corporates and companies do that. I think even the USCIS, which is the Immigration Department of the United States government, I think they offer it too, right? Like it's kind of an entrepreneurship a model where you're trying to find innovative people to work and kind of grow businesses and then spin out and do them on their own. Yeah, one extra thing is that the VC firm would usually get first dibs at investing in their entrepreneurs' company. So again, a way to go more downstream, right? And a way to get the first look. The second one, so the EIR model has been around for a fairly long time. The second one, which has really become more widespread, I'd say, in this decade, in the 2010 to 2020 time frame, it goes by venture studio or startup studio, right? That's usually the name given. And what happens in that is, a group of, let's say, 5 or 6 partners start a venture studio, and the idea is that they want to test out the most promising hypotheses that they have, quickly validate their hypotheses by market validation, market sizing, trying to find a product market, well, not product market fit, but more like idea market fit. And the idea is, let's try out 10 ideas which we think are most promising. Let's try them out in 6 months, use a very data-driven approach, and then look at what the 1 or 2 most promising ones are. And then either one of us 5 or 6 can go create a company in that particular space, or we could hire someone externally if it's a fairly focused subject matter area, or someone from the outside could come in and pitch an idea to a venture studio and they could grow, right? And the idea is that they have a lot of resources where they can do this in a fairly, the idea is to mitigate risk, right? Which is the first 6 months of a startup's lifetime, where they are unsure of whether the problem actually exists, whether the market need actually exists. So doing that in a far more resource extensive manner takes that risk up, right? That's another model. And then then the company kind of grows within the venture studio, and the founders and the venture studio get much less dilution, because angels and seed rounds usually are done by the venture studio itself. So the dilution happens much later. So it's kind of a win-win again for both. And some examples are, you can even call, so Atomic VC is a famous example in the US of a venture studio. They've had startups like Bungalow, Hims and Hers, that actually is just merging with a SPAC right now for over $1 billion. So very successful outcomes. Technically, I think Google X is also a venture studio, right? They spun out Waymo, Verily, all of those startups from within Google, and which was the same kind of idea. So that's the venture studio model. And the third one, which I think is actually the most interesting, or at least in my mind, is the ETA model, which is entrepreneurship through acquisition, where the entrepreneur kind of raises a fund, typically called a search fund, because you're searching for a company or a company to acquire. And the search typically lasts for 18 to 24 months, so about 2 years. And the idea is that you will look for a company which is well run, in a fragmented industry, has strong recurring revenue, does not have customer concentration, has clear opportunities to add value, all the sort of typical things that you would look for in a large private equity buyout kind of, target company. And then you acquire it with a mix of debt and equity. And then you run it for 5 to 7 years, and then ideally, grow it, pay down some of the debt, grow the EBITDA, and hopefully have some multiple expansion, and then can potentially, sell it to a lower middle market private equity firm. And the reason why this is amazing is because, you're technically kind of running a company day to day as a CEO, at the age of 30, right? And it's an established company. So you're not having to go through the idea stage in some ways, and you're buying an existing company that is, that has customers, that has revenue. It's a going concern, and based on your risk appetite or your sort of comfort with the uncertainty of the early times of the startup, you can choose one of the three, right? That's the scale. In the EIR thing, you kind of have to come up with everything from scratch while having a little bit of support from that ecosystem, whereas in this, you're buying an existing asset. So these are the three, functional trends, not sectoral trends, but functional trends that I think are becoming more and more mainstream, these days.
Talking about the Indian startup ecosystem, which of these models do you think would work well in India and why?
Right, right. So I think again, I think India also has, or, a version of these models already, right? So they do exist, and maybe they exist a little bit more informally, and the exact terms are not used, and maybe the ecosystem is not as mature, but they definitely exist in India. I think within these three, I would say that the first two, the entrepreneurship and residence, which I think is actually fairly common in India at this point, and the venture studio, which I think jury's still out, but venture studios have started. These are the two that I think are more relevant to India, and the reason I think is because what you need for both of these models to succeed is uh, enough of an ecosystem of repeat founders, both in terms of wanting to become either EIRs or wanting to start a venture studio. Basically, some sort of track record, which India, has an abundance of at this point. 20 years back, maybe it did not, but at this point, there's a fairly robust ecosystem of people with so-called sort of founder track record, and also in an angel capacity, right? Because you also need people to understand this ecosystem and then in a way sort of give back to it, through investing, and then also more importantly through advising, right? So if the ecosystem is more robust, then you have a network of advisors and sort of mentors that make this an actual value add, right? And I think that's one of the reasons why both these models in India are at least now, I think you can easily see them working, and I think the fact that they are sprouting up shows that there is a lot of merit, at least theoretically, in this model. I think the second reason why I say the two of these are more amenable to the Indian ecosystem is because at this point, the best way to frame this is that at this point, there has been the startup ecosystem is mature enough where there has been enough experiments where it's easy, or at least it's easier to understand what works or what doesn't. And why I say this is because in the beginning there was sort of the US model which we could have learned from, but there was not enough data. There were not enough data points in the Indian model where we could learn what works specifically in the Indian context and what does not. Now we've had sort of over 20 years of that. So when you're trying to in the EIR model or the venture studio model validate your hypothesis, what signals to look for, right? In a much better way than you would have been able to a few years ago. So I think that's another reason why at this time these could be very, very powerful models in India.
Sure. And what about ETA? How do you sort of see that in the Indian context?
So the ETA is actually, it's a very interesting question and a very interesting thought exercise, in terms of whether the ETA model will work in the Indian context. So there's two things. So at a higher level, the reason why I think the ETA model has become very pervasive in the US, or very institutionalized actually, in the recent, in the last sort of few years, is that there is an abundance of companies that was started by the baby boomer generation, where they are now, sort of retiring, and a lot of those very well-run companies are now in some ways, waiting to be sort of taken to, or the best way to frame it is that, they're looking for someone as a steward of what they've built over their entire lifetime, and are willing to hand it over to them, as they want to retire and get liquidity for their life's work, right? So in the last, I would say 10, 15 years, the abundance of acquisition targets has really, increased, right? So that's one. And I don't think that is yet the case with India, right? Where I don't think structurally the number of actually there's the number, and then there's also the mindset, right? The US
Yeah.
generally has the mindset where it's very okay for someone to sort of build a company, run it, and then try to have a liquidity event a few years later, right? And not necessarily pass it on to the next generation, right? In India, I think the number of potential companies that you could make the ETA model work for is lower. And I think the mentality shift is not yet there. And I'm not saying one is better than the other or one is more right. I'm just saying it's different. The other, if we look at if we go deeper into this, right, the ETA model, how do you actually make the ETA model work? Like, how do you actually generate returns in that? And there's largely three levels, right? So there's the first one is the same three that exist for creating value in a typical private market deal, right? The first is EBITDA growth, right? You grow your EBITDA, and because there's the acquisition price, which is the purchase price multiple times EBITDA, and then there's the selling price, which is the multiple at which you sell times the EBITDA. And if your EBITDA has grown, obviously the selling price is higher, right? So I think EBITDA growth actually is very, very possible in the Indian market, right? Because general growth in the Indian market is actually much faster than most of the developed economies, right? But then if you look at the other two levers, there's multiple expansion, and what let's say you buy something at X times multiple, let's say 4 times you buy a company at a 4x EBITDA multiple, and then you grow the company and then you sell it, at a higher multiple. That's another way you sort of increase the purchase price. I think because, and this relates to the first point, because there is not that many number of companies that you could acquire, the ones that are, in that ecosystem actually command a very high multiple. So I think it's much harder to buy low and sell high, right? Because I think it's very hard to buy low. So if you buy high, then that already kind of precludes you from selling high, because it's very hard to grow that to that multiple. And the last thing, and I think this is the most structural part of why ETA is currently hard to do in the Indian context, which is that access to the beauty of why ETA I think works here is because of SBA lending, which is Small Business Association, which is a program I think by the US government, where you can lever up a company up to almost 70-80%. The debt markets in India are not I think as mature, where access to leverage, it would be very hard to think of a 80% debt, 20% equity capital structure in an Indian business, right? It's I think it would be far more skewed towards equity. So I think that's structurally probably the hardest reason of why ETA would be a little bit harder in the Indian context.
For my last question, Divyang, I want to understand from you. A lot of Indian entrepreneurs have moved to California, especially the tech guys, to be closer to the hub of innovation where all the action is, while their engineering teams continue to be based out of Bangalore or some other Indian city. And the exodus seems to continue. I'd like to understand from you the kind of impact Silicon Valley has on Indian entrepreneurs and their growth and evolution in general.
Let's actually analyze. It's a good question. Let's actually analyze, sort of the 2 or 3 parts of the question you asked, right? Which is that there's an exodus happening of Indian entrepreneurs to the valley, especially the tech entrepreneurs, to the hub of innovation. I actually, I don't fully agree that this is the hub of innovation, or the flight is because oh, sorry, I mean, I don't mean to say this is not the hub of innovation. What I meant is that I don't fully agree that the reason why this is happening is because the Silicon Valley is, necessarily more innovative than, India. I think, I actually personally think that that India has, a lot of innovation itself, and incredible talent as well. I think the reason why a lot of people are moving here is because they're not necessarily moving here to be closer to innovation. In my opinion, I think it's much more to be closer to uh, you know the end customer, right? And the reason why, and this is very very interesting, because you mentioned the word, a lot of specifically tech founders are moving, right? And I think you'll see this especially in sort of B2B software companies, where you'll have one co-founder move to the US, and one stay in India. And I think that's because, in terms of the ability of businesses to pay for services in India, in that respect, India is not as mature a market as the US. So I don't think it's necessarily less innovative. I think the idea of using businesses paying for software is not as well entrenched, and the paying capacity is lower. So I think the reason why a lot of founders are moving here is because they, so look, well, they're moving to be closer to the end customer, right? And the reason you want to be closer to the end customer is because if that is where your sales are coming from, right? If that's where your revenue is coming from, it's much easier to do your enterprise sales, in person or face to face, or in the region itself. Secondly, if you're closer, you're also being able to get much more feedback on your product much quicker than you are in India. So then you can then implement that, much faster if you're closer to your end consumer, right? So if the money is here, in terms of your customers, it makes more sense to be here, right? In that sense. And then the third thing is, I think access to capital is still, access to very large capital, I think, is still one reason why the Valley still is a place where a lot of founders tend to go. But having said that, it's actually not very different if you think about it from from the model that we had, sort of the first wave of Indian IT outsourcing, right? That was the services model, where it was the same thing, right? You would have the talent in India, and then you would have the customers in the US. I think now the difference is that because there is so much talent in India, because of a lot of structural changes, such as servers being able to be located anywhere, the barrier to entry of starting something being much lower in terms of the technology required, and just like, collaboration tools being what they are, it's actually now much easier to launch product first companies in India as well. So you don't necessarily have to have just the labor arbitrage element, that you used to have sort of back in the day, but you can actually launch a very innovative product first company in India, and then have someone be here, to do the sales. So which is why, if you see, not all the founders are moving. Actually, a founder is moving, but then a co-founder is also most of the time staying in India to actually, manage the product. And it's not just engineering teams, the product teams, the engineering teams, many other teams are also in India. So I think that's part, the reason why, the movement is happening.
Interesting. Also, a lot of these founders who have moved, they talk about these famed developer meets, and it's interesting that you mentioned that by doing this they're closer to the end user, because at the end of the day it's them who's using the product, and then if they like it, then they're going to go back to their company and say that, hey, we want this, right? And so yeah, I mean, the feedback mechanism is perhaps better if you're there in person, right? Interesting. Divyang, on that note, we'll wrap up today's discussion. Thanks once again for taking the time out and sharing your thoughts with us today. Some very interesting insights. Thanks.
Thank you so much, Marco. Really appreciate it. Thanks for taking out the time.